Okay, welcome. I think we're live now, and welcome to another fabulous season of Earnings 360. I think it's year six, maybe season 25, starting to approach Simpson numbers. Not quite. So let's kind of get right to it. Let me get my glasses on. I want to thank everybody for coming here. Hopefully, it'll be worth your while. So let me introduce myself, Steve Smith. I have over 30 years of trading and investment experience. Um, I started off on the American Stock Exchange, but that was short-lived, only about 6 months. And then I went out to Chicago for the Chicago Board of Options Exchange, where I was a market maker for about 7 years, from like 1990 to 97. So I'm definitely aging myself. I'm closing in on the big 6-0. I've worked running some newsletters and writing about financial markets in various capacities, including about a 7-8 year stint at thestreet.com. I was a risk consultant for New Vernon Capital, which was a hedge fund, and they were looking to manage their risk kind of after the financial crisis in the 2010 era. And then I joined the Adamesh Live group in about 2015 and been running the Options 360 service. And this, what we're going to talk about today, Earnings 360, like I said, for about 6 years, and contribute in various ways. So I'm going to, given my background, I take a very option-centric approach to earnings. I think I had, this may not be the slide that, okay, we're going to have to see. I wanted to show you the performance of it, but let's just get right to it. I may have loaded up the wrong slideshow. I hope not. So the Earnings 360 approach is I'll do some analysis of the fundamentals, such as what are the estimates, what are the revisions, what's the history of the company meeting or beating, what's the current market sentiment, right? I mean, we're in a momentum market? Are we in a downward market? So is it likely that maybe there'll be a sell the news reaction? Or so that's both the overall market and with the individual sectors. So sometimes you have some beaten down sectors, and all they need to do is kind of do okay, and you'll see a big pop in the stock. Also want to look at some technical analysis. Keep that also pretty simple. Just the chart. What's the recent price action? Heading into the earnings, has the stock run up? That may set it up for a sell the earnings. What are the support and resistance levels? That's going to help us choose what our strikes that we want to use. What have been the past reactions? Over the past, usually look at like the past 12 quarters. And then most importantly, we're going to look at what are the options pricing in, and that's the implied volatility. And we're going to always use spreads. I think that's behind my face here. Is reason we're going to use spreads is because it boosts our probability and our profitability, but mostly our probability of having a profit. So let's start to drill down. I'm going to cover quite a bit here. Hopefully it's helpful to you. And then actually in the midpoint, I'm going to go on and just put on a trade, show you how it works. Implied volatility is really the X factor when you're talking about an options value, right? If you look at a basic Black-Scholes model, there's 5 inputs. Stock price is known. Days to expiration is known. Strike price is known. Interest rates, which now have only in the last first time in like a decade have mattered, but they don't really matter for us, is known. The implied volatility is the variable, and that's basically trying to predict what the stock will do in a given frame of time. So let's drill down a little bit more into volatility, because my whole approach here in Earnings 360 is about harnessing implied volatility. So we got to know what we're talking about in a way. So volatility measures movement within a given time frame. It's backward looking. Implied volatility, historical volatility or realized volatility is backward looking. Implied volatility is forward looking. Implied volatility is the probability of a move within a given time frame, and it is non-directional. It's just the magnitude of the move within a given time frame, right? So Let me just let's go on. So here's a yeah. Okay. Sorry about that, guys. So here's a way to look at like implied volatility. Did I miss one of these? I don't know if who decides on implied volatility? I took this. This was an old slide. Like I said, been doing this for quite a while. So, but this still stands. You can think of like an election or Brexit. They were like an earnings announcement for the overall market. So here's what the SPY implied volatility versus its historical volatility was leading into those events. And you can see implied volatility increased dramatically in front of both of those events. And then immediately after the event, even though the realized or actual volatility jumped, certainly after Brexit, the implied volatility collapsed. Another way to look at it, also with an election, heading into the 2020 election, you can see this is the VIX futures, right? That big hump that represented, I took this snapshot in July, that big hump is the November VIX futures. So you can see they were pricing in a big move, and then the expectation that it would revert to the mean, that volatility would come back down once that event was over. And that's really all that earnings are. So now here we get into a stock specific situation. This was a Netflix. This is the image for Netflix realized or historical volatility versus the implied volatility. Once again, you can see how that yellow or gold line, the implied volatility, runs higher and then pretty much collapses right after the event. So you have this reversion to the mean, right? So we can say that somewhere, if we drew a line down the middle, Netflix volatility typically was in the 40s, and it can go scattershot, both the realized and implied go up and down below that. But there's a reversion. So there's two types of trades we're going to be looking at to capture that. Harness that decline in implied volatility, what I call the post-earnings premium crush, or Pepsi. So on those trades, what we're going to do is put on the trade the day before earnings and then hopefully close it out the next day. And the expected return is somewhere about 75 to possibly 150% gain. The expected win rate is 65%. And towards the end, I'm going to show you all the breakdown of the numbers of how this service is done. And then the other trade is Peppy, which is something that we put on like a Monday or Tuesday, but on the week before the earnings, and then we take it off on Friday. So we do not hold it through the earnings event. So one is basically a 24-hour trade. The other is a 4-day trade that we close before the earnings event. All right. So again, let's drill down into now. This is the strategy, right? Is Pepsi is a post-earnings premium crush. So there's many variables that can go into earnings, whether they're going to meet, beat, right? What's priced in, kind of talked about that. But the only thing we can reliably predict is a decline in implied volatility follow the earnings. Now, this doesn't mean that it may not move beyond what's expected, but the implied volatility of the options is certainly going to come down. It will not expand anymore beyond what it was heading into it. So that's the goal here, is to harness that post-earnings premium crush by using spreads, and sometimes we even use different time frames. All right, just a reminder of this. There's that reversion we want to capture. So let's go to the option chain here. I need my glasses for this one. So this option chain, it shows from a bit ago, but this is all evergreen because the strategy doesn't change. And we're going to get to, I'm going to make a live trade somewhere on here. As you can see, the week before that doesn't contain earnings, the implied volatility was 29.5. The week that does contain earnings, it was 66, right, or more than double. And then as you move beyond earnings, implied volatility for these options starts to revert, and it's 47. So in a quick back of the envelope way to see what is being priced in is you take the at the money straddle that in this case would be the 195 call and the 195 put. Add them up, 1620. So if you were just to buy volatility here, buy a put and a call, because you're expecting a big move, you would need an 8.3% move to break even. So that's what's being priced in, $16 or 8.3% move, right? If you just took a side and you took the 195 call, you would need an $8 move or 4.1% to break even. We're going to try and improve those odds by using a spread. And so in this case, we're going to still use the 195 at the money call. We're going to buy that to open, and then we're going to sell one contract of the 205 call. $10 wide spread. We're paying $385. Okay, so we've already reduced our cost from $8 to $385. So our risk is already lower. What does our reward look like? You can still more than double our money. If you wanted to double your money on the straight purchase of a 195 call, you would need something like 15% move maybe. But if you just had what is priced in and the stock moved from 195 to 205, you bought the 195 call, you'd only have earned 25%. On the spread, on a 4% move, less than half the move, you would get let's call it 150% return. So we've reduced our cost and actually boosted our return. On a smaller move, right? Certainly on a similar move. So I'm going to get to, I see some questions and I'm trying to not get distracted. You know what? I have the wrong slideshow up here. I don't know if that's going to be an issue when we get to the offer. Jeez. I don't know how I uploaded this one. That's so Sam, I'll get to all the questions later. Skipping that. So let's see why we want to use spreads versus buying anything outright. Right. So here's just kind of a grid, and we're going to be focused on what's in that circle. So again, just to run through the quick numbers. The 195 call, if we bought that outright, paid $8. If the stock is down, we'd lose all our money. If the stock is unchanged going across the top row, because of that post-earnings premium crush, we would lose more than half our money. If the stock is up 5%, we may gain 33%. And then, yes, we can have big gains if it's up more than expected. Remember, the expected move was 8%. If it moved like 10%, you can get that 160 plus gain. Let me just see something. Okay, thank you, Patrick. Now let's go to a spread. I'm going to go to the third row. We already kind of looked at that 195, 205 spread. We did now let's go what I really do most often is the 190, 200 spread, right? So the stock was trading 195. So now we're $5 in the money, right? We have $5 of intrinsic value and we're only paying $4.70. So if we go across the row, you can see if it's unchanged, right? We break even. We don't lose any money. That's versus if we just bought that at the money call, we would lose half our money if it doesn't do anything. If we're buying something that has intrinsic value and the stock doesn't move, we're harnessing that post earnings premium collapse. And we can break even. And then again, the better side of it is that all the stock needs to do is move a little bit in our direction and we can double our money. We can have 100% gain. The con is that if it's an outsized move, we're capped. But that's, what do they call that? That's a first world problem. If I'm able to double my money overnight, I'm happy with that because I've reduced my risk. I've given myself a better possibility of not losing money. So I have a much higher probability of either not losing or making money. And the only thing I'm giving up is really outsized gains. And that's okay, because this service is all about consistency, not using lotto tickets, and just hoping that something goes berserk after earnings, or doing something that is unlimited risk of selling both sides. We will do on condos. We got to. All right, so let's start to see how these get written up, what you'll see in the alerts, right? So this is Philip Morris, PM. I'll give you what the current price is. I'll give you these stats that are up on the upper left of the alert, what day it reports, what the implied volatility is, what the strategy is. So in this case, the expected move is 4.8% or $3.65. We're going to use a bull call for vertical spread, just like I kind of showed you. The entry is, I'm going to give you a price parameter, is 70 cents. Don't go above 80 cents. The exit target, because we have a spread, we already know what our max return can be, so we can already kind of put in what our exit plan is, and which in this case is 140, or double our money, right? We're going to pay 70 cents. We want to get out at 140. Then I'll write up a little something about why I'm maybe taking a bullish position. Used to be able to, now we're not having images, so I just want you to focus on the text. So I'll write up the exact text of what the action is you should take, right? Buy to open 3 contracts of the 72 calls, sell to open 3 contracts of the 73.50 calls. And that's going to be a net debit of 70 cents. And I say again, do not go above 80 cents. Let's see how it worked out. The next morning before the opening, I will always send out an alert before the opening about how the stock is indicated to open and what our exit plan is. So it's indicated to open up about 4.3%. It's $75 a share, right? That puts our spread, our 72, 73.50, fully in the money. But this might have been a Monday or Tuesday, so there's still some time remaining. And you'll never get $1.50. You'll never get the max value on a $1.50 wide spread. You'll never get $1.50. You may get $1.45. There was probably some time remaining here, so I said, let's try and enter an order to close it for $1.30, which is a 70% profit. And then we also have a risk management line where I say if shares drop below 72, we'll exit. And the reason I do that is that way, right? Because that would be kind of unchanged. And that way we recoup our money. So it's about the management of the risk is a big part of this here. All right, let's look at a slightly different variation on the vertical. In this case, we did a bearish position in Harley Davidson. Again, you get the price, what day it reports, what's the expected move, the strategy. In this case, it was a bear diagonal. What's the entry price over on the right-hand side? So you can see the text of exactly what the order is. And in this case, what we're doing is we're buying something that's a week out and selling something that's the week of the earnings. So that differential in the expiration, what that does is it gives us a little bit of a cushion that in case there's an adverse move initially, we can still recoup. We can either adjust it by rolling, or we'll end up being able to recoup some of our premium because the one that we bought is a week further out and we'll retain some premium. This turned out, I think we have a better slide here with the summary, is what did we do? We entered that diagonal spread. Again, two different expirations, but it's still just a vertical spread. It was bearish in this case. We spent 90 cents. The stock dropped 5.5% following the earnings report. We took a quick profit. We closed the position for $1.55 or a 72% return. And we did have the flexibility, again, in case the stock moved higher for some reason. And then that would depend on, whether I wanted to just close it or extend the trade would depend on, sometimes I actually have an opinion and say, hey, this reaction doesn't seem appropriate to what the earnings were. And that's another thing you'll see with earnings is managing the exit is kind of important because there's oftentimes some pretty vicious reversals. So you can say something's like indicated to open up 5%, and 10 minutes after the opening, it's down 5%. So that's one of the tricky things, right? We have our tailwind of harnessing the option pricing, but we can't control that reaction sometimes. So let's go real quick. Iron Condor, for those who are not familiar with, um, is basically selling two credit spreads. And in this case, you want the stock to stay within a range. So when I give on the upper part, the strategy, Iron Condor, this time our entry price is a credit. And I say, do not go below, right? We need to collect a certain amount to make the risk reward worthwhile, and then our exit target will be a debit. And in this case, we were looking to close it for 15 cents, sell something for 80 cents, and close it for 15 cents. And here, again, I'll write up exactly in text form the actions you need to take to structure this trade. And this is how this worked out: is we sold the Iron Condor for 75 cents. The stock remained within the strikes. We closed the position for 15-cent debit. That means we collected $60 of net premium, making it a return of 48%. Remember, the risk was $1.25. That's because we collected 75 cents. The spread between each strike was $2, meaning if one side or the other went fully in the money, our risk was $1.25. Again, all these trades have a very defined risk. And typically what we're risking is about $200 to $300 per trade. Okay. You know what? Why don't we go here now that we did, before we get to these peppy trades, let's see if we're going to put on a trade in a live trade now. You guys want to do that? Just to see how these vertical spreads work. So we've had a lot of the bank earnings. Can I just go to, yeah, okay. But I think I need to, right, if I want to control what you're seeing, TSM, is that, yeah, probably, okay. So I'm gonna, yeah, I see what it said. I should have used my second screen here, but we'll work with it. So we had a lot of the bank earnings today. They were all doing very well. I didn't have, let me go back here. Trade. Oh, no. Bear with me, guys. We can look at some charts. So we had, I was thinking of doing Morgan Stanley, but the issue is it's up 5% today already with, JP Morgan reported. I think Bank of America reported. Goldman Sachs, which is the closest to Morgan Stanley in a way, and they're all having 5% gains. So I'm not sure I want to do Morgan Stanley with it already being up 5% on the day. So let's take a look at TSM, and I wanted to show you. I trade on Tasty, but I couldn't because it's, somebody can explain it. I couldn't get it on this streaming platform yet. We'll work that out because it's web-based or not web-based. Oh, it's desktop. It's the desktop I have. All right. So let's take a look at, and some of the things that go into that I would consider, right? So we have Taiwan Semiconductor. First thing we probably would look at is go to the at the money options. Right? It's trading 205. We want to look at the 205 straddle, add that up. We get about $12, $13. That's the expected move. In percentage terms, divided by 205 is about 6%. All right. So we're expecting like a just shy of a $13 move, maybe about $13 or 6.5% move. So here's some of the things I would consider. So I looked at this stock is they've beaten estimates 9 out of the last 12 quarters, and they've had a positive response 10 out of the last 10 quarters. More recently, there's been some concern about, the preventing chips from being shipped to China. Some of the exposure maybe that as far as the auto industry. So see, these are some of the negatives because I'm leaning towards doing a positive bullish trade in this. And also, even though they'd make chips for NVIDIA's moved to Blackwell. They don't really make the Blackwell chips, so maybe that takes away from some of the other orders. But basically, they've been very positive about what the demand is. So I'm going to look with the stock trading 205. I'm just going to go in the money and do something very simple, and I'm just going to keep it at one contract, and I'm going to go after this because then I'll send it out to the people who are already members of this service. I'll write it up and go to my tasty trade and make the trade. So here we have it's a 250 wide spread, right? We're going to buy the 2025 call, which is $2.80 in the money, right? The stock is trading 205.50, right? So that's already has intrinsic value. So does the 20, and then we're going to sell the 205. So we're buying a spread that's totally in the money that has $2.50 of intrinsic value. And just to get it done, I would probably put this in usually to work it, but just to get it done, I'm willing to pay $1.40, which means, we're paying just over half of what the intrinsic value is, right? So put that out there, and of course it gets filled right away. All right, so I just wanted to show that that's kind of the thinking of like how you're using something that has intrinsic value, how you're using a spread. So now if this stock doesn't go anywhere, it stays at 205, that spread is fully in the money, and it may take a day or two, but that $1.40 we spent will go to 240, right? It's not going to go to 250. Just doesn't work that way. But we can, have a very nice 80% gain on the stock basically not going anywhere. So that's how you use a spread to capture. You don't always have to use an iron condor to say I'm selling premium. We're selling premium by just using spreads that have intrinsic value. So all right, let's go on. So that's kind of the post earnings premium crush approach. Maybe you know what, at this point, is there any questions? I could take some questions on this before I move into like the pre-earnings, the trades that we make that occur before the earnings. Any questions on something? Question, Sam? Yeah, shoot it to me. All right, you just wrote question, but you know what? That I'll point out something. That's why I don't use this anymore. And you can see this is just a paper trade. Is they call that. This goes back to when there was just monthly options, and they expired on the third Friday of the month. So this is the 17th. If you see up here, the next expiration is the 24th, right? So they call their month. People get confused on that. So one of the reasons among many that I stopped using it. Now we're buying. So it was the 202. We're buying the 202.50 and selling the 205. We can, if you want to see. So I'll show you this was the order again, and this 25th is the 17th. They call anytime it's the monthlies, they just put the year. And then on the weeklies, they give the exact date. So we're using the January 17th on most of your other platforms. Sorry, I can't show you my tasty. This is just a quirk left over from way back when there was only monthly options. All right. So if you look across the top, right, February, they have February 25. That I don't know exactly what day that is, but that's the third Friday of the month. So again, this is the third Friday of the month, is the 17th, which is this Friday. And then you'll have the next week is the 24th. So yeah, so we just have 2 days, and that's, yeah. So thank you, Gavino. Hope I'm explaining that well. This is a quirk of E-Trade left over in there. Instead of just showing the exact date like they do with all of them, on these monthlies, they show the year. So, oh bueno. Okay, let's go back to our presentation. And can I do that, Patrick? How do we get? Yes. Okay. So let's meet Peppy. This is, I just kind of made this up a little bit. It's pre-earnings premium expansion. To go back to the other thing, Sam BS. So the trade has to be above 205 to be profitable. No, actually, give me a quick. To be profitable, we only spent $1.40, 202.5. Wait a second, 202.5 plus 1.4. So our break-even point is actually 203.90. So anything above 203.90, we would have a profit. So, but the max profit is above 205, and we would probably, like I said, if it's 202.50, we'd probably still be able to get out and break even, just because the collapse of the implied volatility of the premiums in there. So we have a break even of 203.90, and actually that would probably still give us a profit, just because the 205 call that we're short would lose most of its value, and the 202.50 that we're long would have value, not only some time, but it has intrinsic value. All right. Okay, so let's meet Mr. Pepe, cousin to Pepsi. This one is the one we would establish these trades on a Monday or Tuesday. And we'll use a calendar spread, actually like a double calendar, and we're going to take advantage. Again, this is the other side of where implied volatility increases ahead of earnings, and then we don't care about the collapse afterwards because we're getting out of the trade before the earnings. So what we're doing here is taking advantage of a differential of the week that contains earnings versus the week that doesn't, and the difference in that time decay. All right. So let's just look at an option chain real quickly of Schwab. You can see the implied volatility the week that does not contain earnings is 26%. The week that contains earnings is 31%. So slightly higher, not a big skew in this one. And then it starts to revert to the following week. More importantly is this theta, or time decay. The time decay of the week before earnings is 6.5 cents a day. The time decay for the one that we're going to buy that contains the earnings, that's the week of earnings, is just 5%. And so let's see how we structure these trades. It's a double, you can call it a double calendar, a double strangle. But what it is selling both a put and call of the week before earnings, right? Collecting that premium, that's going to be where our profit is. Then protecting that, because we're not going to sell anything naked, never selling anything naked. We're going to buy the same strikes of put and call for the following week that contains the earnings. But we're going to exit it first. So that's just the way it's structured. Let's look at an actual trade. I ended up not making that trade. Calls, I'll give you all the information. Let's go through this quickly, right? I think this is a better way to look at it. This is the trade that we made as we sold the 74 put and we sold the 77.50 call, right? And we collected about a dollar, right? 60 cents and 70 cents on that. That's what we collected. Now, to protect ourselves, we bought those same strikes for the following week that has earnings. Overall, we paid $3.20, right? So our goal is to have the stock kind of stay in this range, and for the options that we sold for the current week that do not have the earnings, we want those to approach zero, and that's our that's where we get our profit. The other ones are really for protection, and that we also know that because earnings are coming out, that they'll probably hold on to their premium pretty well, if not actually increase, as that implied volatility goes up as you head towards the earnings event. So how do we exit this trade? This was on a Friday. We exited the trade. The stock did not move much. It stayed within between 74 and 75, 77.50. Those were our strikes that we straddled it with. You can see the value of the ones that we sold went down to 5 cents and 40 cents, right? And the ones that we bought kind of held on to their value. And now we're able to exit what we had paid $3.20 for. We're exiting it for $4.50. And that's without taking any directional risk, just letting that differential between the time decay work in our favor. So that's a nice solid 30% profit without much risk. So these pre-earnings trades, they're a little less profitable, but I look for 25 to 30% profit, but they have a much higher probability. Their win rate is in the 80% range. All right. So here we go. This is where you might want to, if you can swap out, I think we're going to be getting, to, are you able to do that, Patrick? Swap out to the other presentation? Sorry about that. Okay. So let me just see. Well, I want to, I want to show just some of the stats on it. So, and I can't control this. Can you go back a page on this one? Yeah. So here's the total returns. Go back. Yeah. Okay. So let's see. So the performance, this is actually, because this is the old one, it's actually like 25 quarters. These numbers actually, as far as the average gain and things, are pretty much exactly the same as they were for this from the last quarter. So we're up to now somewhere like 765 trades. The win rate is still at 62%. The average gain is 44%. The average loss is 30%. These PEPI or pre-earnings trades have a win rate of 80%. And the average earnings per quarter has been around $1,200. And you can see, and we're only putting up like 200 to 300, call it 250 per trade. So having the winning trades average just about 110. Some are larger than others. We have some max gains, we have some max losses, but the average is these are the numbers. Is $110 on a $250 allocation. Works out to what, something around 45. Yeah, it's 40. Is exactly what I wrote. 45%, and the average loss about 30%. So those are the numbers. That this is something that's is trying to just be consistent, turn earnings, which most people view as very speculative, into a consistent generator of profits, and that's that equity curve that you saw. So all right, now we can look at what's the great offer we're going to give you guys. Maybe Josh can, well, I'll tell you what we can get, and then we'll bring Josh in and can really explain more about what the offer is. Is usually there's 3 to 5 trades per week. the program runs each quarter about 6 weeks. So we'll have about 30 trades over the course of that 6 week period. You get the detailed alerts and the alert the follow morning. Um, you have access to the real-time portfolio, and also I'll do web calls each Friday to both review and preview um, what we'll be looking for, what we did, and what we're looking for. And most importantly, that's a chance for you guys to answer questions. All right, let's get to how you get to this great
Steve, can you hear me
program.
now?
Yes, and the
Hey,
one thing I'd also like to say is what's great about this in terms of earnings. So there's two things. Let me do my little sales thing. Is this is good for people who want to just add more trades, right? And that they're not correlated to the market. So right, we're starting to see more volatility in the market. You're starting to see um, concerns of the past 2 weeks. The market didn't start the new year that great. You had a 5% pullback. So these are very uncorrelated trades. They're isolated 24-hour events in the most part, and so it's a good way to kind of have something um, that doesn't feel like you're being swayed by if you come in one day and the market's down tremendous amount. You may still have an earnings play that's up 5%. So it's a good way to you know add trades that are not necessarily market dependent. All right. So here's the offer. Josh, you can read it out.
thanks, Steve. Can, can you
I'll
hear me
take a
right now,
sip of
Steve?
water. Yeah. Thank you guys for y'all, and I'll be here for questions for sure.
All right, hello everyone. If you could hear me, just type yes or Y in the chat, just so I know. I believe you can though right now.
And there's definitely going to be a recording. Um, for the people are asking a recording for this.
Okay, there we go. So you guys can hear me. Oh, hey, Christian. Um, okay, thank you guys. Thank you guys so much for being on earnings. Obviously, you listen to Steve. He's the one who knows the most about it. Um, I work with you guys, so what the customers that I always work with say what they like about earnings is, first of all, Steve is willing to help you guys with anything. He's willing to answer emails, even get on the phone if need be, but usually he can answer everything over email very clearly and very quickly too. Steve is like me; he's very very fast over email. Okay, there's a lot of action when earnings is on. There's almost a trade every day. I don't want to say it's every single day, just in case we go a day without it, but there's a lot of trades, a lot of ways for you guys to learn, for the people who want to learn, and a lot of trades for people who just want to get those trades. Okay. Now, Steve put the special offer on there, but I'm putting it in the chat right now. I don't know if it's clickable or if you can, Sam, it's almost one trade per day, but I'll go through it. Don't you worry. I'm going to take you to the link. Sam, click on that link. Everyone click on that link or copy and paste it. Just go because we're doing something that we've never done before, and I want to walk you guys through it. I don't think we've ever done it before, as far as I can remember, and I've been with the company for 20 years now. So if you're having trouble with the link, let me know. Write it in chat. And Patrick's watching; he'll be able to help. Or you could wait till after and send me an email or give me a call. But if you can get to that link, I want to walk you through it. Um, like I said, because there is a special. Okay. So for you there now, it says what's included. Access to Steve's earnings, analysis, and trade recommendations. That's very simple. Daily alerts, we've explained that. Weekly live webinars. Every week, Steve will go live on a webinar. You'll get plenty of notice about this. Everything is recorded. It's going to talk about what's going on in the market in general and also walk you through the trades. You're getting access to the Mesh Insider group phone call, which is every Tuesday. And then if you see there, the most important part, 1 month access to Options 360. This is just a full service, one or two trades a week. Another one run by Steve, where he gives you trades. Very successful, been around for almost 10 years now, maybe 7 years or so. Now, if you scroll down a little more, you'll see the price. It's normally $600 for a year, but we've been giving you guys a special for this, which was $499 for a year. But you see $399 there. This is what I'm talking about that we've never done before. For the next 45 minutes, so until 2:30 Eastern time, it's $100 off. It's $399, and it will stay at that rate of $399. Okay, it won't go back up to $499 for anyone who joins during this webinar. Okay, there's another offer which is $199 for 3 months, and I'm going to send out that link as well. Obviously, the 399 is a better bang for your buck, but 199 gives you a quarterly rate, which means you'll get the full earnings sessions and be able to decide if you want to continue or not. For anyone who has questions about any of this stuff, you can put your name in chat. If we don't already know you, I'll look up your information, or you can call me directly. I'll put my number in chat right now, or you can email us as well. I'd like to give you guys a minute to check out the quarterly link as well, and also let me see where you are. There you go. Oh, hold on, 1 second. I'd like you to check out that the quarterly link is going to be in the box, and also the yearly one, as I said. Take a minute or two, check it out, and join. I'm going to come back in a minute or two, take a drink. We're going to come back in a minute or two and just wrap everything up. But like I said when I started, thank you guys for being here. And there's the second link for those of you who'd rather join for 1 quarter at a time.
So
we're going to come back for questions.
Yeah, I would say at this point, if you're getting another $100 off for $399, if you do it, yeah, like you said, in the next 45 minutes, that's the best deal. Because I'm sure you guys are also, if you're, and you get the access to Options 360 for a month, and Adam's Tuesday call, you said? Yeah.
Yes, the Tuesday call is the Mesh Insider call. Okay.
Cool. Yeah.
And
yeah,
that's a great
so
call.
I mean, for $399 for the year, that would definitely be what makes sense.
Take a minute, go get it. Like I said, grab a drink. We're going to do the same, and we'll be back in 1 or 2 minutes to go through any last questions and wrap up anything that you guys need. Again, you can post in the chat if you want a direct phone call. I'm happy to call you. That's literally my job. And also the people in the chat who I recognize and recognize me. Thank you guys. You guys are the best. We'll be back in 1 or 2 minutes. Okay. Right back.
I'll stay here, answer any questions you guys have. I can see the chat box. So if you guys have any questions, I would love to answer them. Oh, Sam, how many trades do we get during the 6 weeks? So you figure this kind of started now, will run to the end of February. So it's 6 weeks. You probably get it somewhere around 30 trades.
I already see a couple of you guys joining. Thank you so much. I'll be back in 1 minute as well. Thank you. Okay, we're back. Thank you guys again. Oh, okay. Hey, Major. Hey, Major Sam. Bonus 1 month access to Options 61. Yeah, I just going over that a little bit, but sure, I'll go over that 1 second. Roger, the $399 you get 4 quarter. Yes, it's just consider it an annual subscription. It's $399. It'll renew at $399 every year. Okay, Roger. Major, 1 month of Options 360. Options 360 is a separate service from the Earnings 360. We're not setting up any automatic payment for this. Okay, I really want to be clear. This is just, hey, you're going to pay for earnings. Thank you so much. You can also try out another service run by the exact same guy. Again, a service that's been around for almost a decade now with great results. I think it's had a losing year or two, but not more than one or two, and maybe even less than that. Maybe I'm wrong, but certainly a very, very winning service, if that's the right way to say it.
No, Options 360 has never had a losing
Okay, I
year, and
apologize.
it's
Never
been
had a
a,
losing year.
and we've
Thank you,
had
Steve.
the earnings of 25 quarters. We've had 3 losing quarters, and they've been less than $500, the loss out of the 25.
Yes.
So
So you
20,
get access to Options 360 for a month. After a month, I will reach out to you. Either I will or Gavino will. You guys know Gavino. One of us will reach out to you and just see if you enjoyed it. That would be the best thing. If you enjoy it and you want to pay for it, you should be excited because that means you found a service that you like. But under no circumstances will there be a payment for it unless you decide after trying it that you'd like to. Peter, do you have to take every trade to be successful? No. If I would actually suggest avoiding the trades that are going to lose, if that makes sense, and then you'll always be successful. Okay. No, just kidding. We realistically, we don't expect anybody who's following this to do every single trade. Okay, it's just not realistic. It really
well,
depends on what happens. Of course, you can miss the good ones, you can miss the bad ones. We don't expect everyone to take every trade. The golden rule is take as many trades as you can if you're paying for a service, and the golden
yeah.
rule is act as quickly as you can.
Well, I'll add something to that. Is I would kind of suggest doing, because this service is really about saying, okay, we have this tailwind of post earnings premium crush. It's a probability based service. Is you want to try and say, if you cherry pick something, you're not following what, I don't want to call it a system, but you're not following the strategy. And part of the strategy is saying, hey, we need to get at least 20 to 30 trade, minimum of 20 trades per quarter to say that our edge of post earnings premium crush is going to work in our favor. So we've had some times where, we start off great. Maybe we have 5 winners in a row. I've also had times where we've had 4 or 5 losers in a row. And that's not when you want to be like, so you have to kind of stick with, my belief is I've been doing this, like I said, it's 25 quarters and it works. So if you start cherry picking it, hey, on any given trade, you can say, you know what, Steve, I think Steve has this wrong, his analysis, and I don't like the risk reward or whatever it may be. But I think in general, if you're, buying into this service, which is also, you're not paying a whole, is to do them. And you know what? I keep the entry, each trade low. And as people who've been with it for years, they gain some confidence. They may customize it by saying, I'm putting on a little bit more risk. I'm doing 3 contracts on this one instead of the one. I'm doing, or maybe I'll recommend something that is $300, but it's only a 50-cent item. Sometimes we do something that's only $1 wide spread and it only costs 50 cents. They may say, you know what, I'm only going to do one. I'm only risking $50, not doing the 4 contracts Steve says for $200. So you can do it that way, but I kind of wouldn't suggest, cherry picking too much about like which trades do I like and agree with if you're buying into the
Yes,
service.
so that's the longer version of what I said.
Yeah, I'll take the winning ones. Yeah, no, I wanted, because you were exactly right. If we could all just pick the winning ones. So I just wanted to give the reasoning behind why you don't do that. Is you don't know what the short answer. You don't know which ones are going to be the winning ones. Yeah.
Great. Anyone have any questions for me? But really for Steve. Anyone have any questions? Thanks, Major. Thanks for that. I was speaking specifically to you with that advice, Major. Dean, we'll get you a recording. If I don't get you one by the end of today or latest tomorrow, shoot me an email. But I'll get you one. Don't worry about that. Okay. Who else has questions? Yes, Patrick just confirmed we will have the replay. It takes a little while to get ready. I go, Tom. Yes, there's a link above where it's $1.99 for a quarter. I don't know if you already joined since you asked that question about 3 minutes ago, but the quarterly rate is $1.99. Although for another 34 minutes, it's definitely worth it to get the year, but that's up to you. Roger, we answered your question already. Oh, maybe that's one of you guys calling me right now. Just give me a minute, of course. Steve, are you good? Do you have anything else that you want to go through, or you want to give them a chance to join up? Oh, and again, sorry, one more second. I want to stress one more thing that we really don't stress enough. The support that we offer is second to none. I like to think that I'm good at being there for you guys. Steve is also. He's just as good as I am. He's fast. He's very good at answering. So you're welcome to, well, email, I suppose. You're welcome to email him anytime during these calls. Is that right? Is that right, Steve?
Absolutely.
Great. I'm good if you are. Again, I'm Josh. You guys also probably work with Gavino. Josh at adammesh.com. If you have a question, I'll write it in the chat again. Or you can call me directly, 212-774-5971. I'm happy to talk about this or any of our services, anything about your account, anything I can do to help at all. Okay? And there's Steve's email. Keep that. That's a good one to have. Nice, Steve. Thank you.
You got it.
That's good. God bless all you guys. Thank you so much, Steve. You're going to end the webinar now?
Yes.
Okay, great. Go ahead and do so, my friend.
So thank you, everybody. Actually, I think Patrick has the power button. So thank you, everybody, for your time. Thank you, Patrick. Thank you, Josh. And I hope to see you guys. We'll start trading some earnings. And we'll see
God bless
what
everyone. See you later.
TSM does tomorrow. Okay, thanks.
All right, thanks, guys. Bye.